Hi, everybody. So I wanted to know if the bank gave you any information about the Community Reinvestment Act. Did you hear anything from the Federal Reserve Board about the Community Reinvestment Act? I have been asking people if they were able to give their feedback during the rules change, and most people don't know what I'm talking about, right? This has more to do with you than you think, okay? And so I want you guys to be paying attention and understanding what is being said and what is happening. So I'm going to share parts of this webinar that the Federal Reserve put on, and we're going to stop and talk about it so that we can all know what has taken place. All right. Let me go to that screen. So here you see the website. We're going to end up going back over there to talk about the Community Reinvestment Act rulemaking that just took place, as you can see right here, on October 24th, 2023, right? The board, the FDIC, and the OCC issued a final rulemaking amending the agency's CRA regulations, Community Reinvestment Act, meaning CRA. All right, and so we'll come back to that in a minute. Let's go over here. As you can see, 3 days ago, they put this video out giving an overview about what all that meant. Okay. So let's start to review what they had to say here.
The Federal Deposit Insurance Corporation, the Federal Reserve Board, and the Office of the Comptroller of the Currency are pleased to present this overview of new regulations implementing the Community Reinvestment Act. The Community Reinvestment Act, or CRA, was adopted in 1977 and is one of several seminal laws enacted to address inequities in access to credit, including the Equal Credit Opportunity Act and the Fair Housing Act. The CRA is administered by the Federal Reserve Board, the FDIC, and the OCC. We'll simply refer to these as the agencies in this presentation. The CRA requires the agencies to assess a bank's record of
Just so you understand, in this presentation, the symbols and seals that you see there are going to be referred to as the agencies throughout the presentation. Okay, so they announced that up front, that from here on out, we'll refer to all of these as the agencies. Okay, so we'll go back.
Meeting the credit needs of their entire communities, including low and moderate income communities, consistent with safe and sound operations. The agencies are responsible for issuing regulations on how banks are evaluated under the Community Reinvestment Act. Supplemented by supervisory guidance, the CRA regulations establish the framework and criteria by which the agencies assess a bank's record of meeting the credit needs of its entire community, including low and moderate income neighborhoods. On May 5th of 2022, the agencies released a notice of proposed rulemaking to update and modernize the CRA regulations, and the agencies received approximately 950 unique comments, which were carefully reviewed and considered.
Did you know about the rulemaking? Were you notified about the rulemaking from your local civil rights organizations or bank? They always try to get you to come out for that financial literacy classes. There's several branches of the Federal Reserve across this nation. Did anybody give you notice that there was a rulemaking and that regulations were going to be changed? Proposed rulemaking to revise the CRA regulations, Community Reinvestment Act, for low to moderate income communities. And I hope that you are a part of the 950 unique comments. Let's go on.
The final rule was adopted by the three agencies on October 24th, 2023. The rule has various important dates, which we will discuss at the end of this presentation. While there is a multi-year implementation timeline, the agencies have already begun the process of planning for additional training for banks and the public, including interagency examination procedures, examiner training, and important tools and resources for banks and examiners. So more to come. Now let's discuss the final CRA rule. The agencies were guided by 8 objectives for modernizing the CRA rule, and we'll highlight several of them now. First, the final rule seeks to strengthen the achievement of the core purpose of the statute by encouraging banks to expand access to credit, investments, and basic banking services in low and moderate income communities, both rural and urban. For example, the new rule expands the geographic areas in which the agencies evaluate a bank's retail lending and the geographic areas where community development activities are counted. In addition, the final rule promotes financial inclusion by recognizing bank activities with minority depository institutions, community development financial institutions, and in high-need areas, including native lands and.
Do you know if your bank qualifies? Do you know if your neighborhood qualifies? Do you understand that this has more to do with you than you think? But a lot of times, because we're not well informed and we don't know even where to start to begin to look for this information, that's why I do this show. Other people that are informed are a part of the rulemaking and also a part of the allocation of resources. And then years after that is when you find out you could have had access. You could have had an opportunity. You could have advocated for yourself with the bank, with all of these rules that are coming out. And I want to talk about that after they start talking about the regulations and the expansion of territory. And it doesn't have to do with just rural. And it doesn't have to do with just urban. It's an expansion across territories, and it's looking at income, low to moderate income, right? And so I want to just stop there to interject that information, because we have to be paying attention to our communities to understand who's making rules, who's going to benefit from that. I asked that question before when I was teaching about power, right? Power. Who has it? For whose benefit is it had? And at whose expense? Are you expendable? Right? And so I bring this information to the forefront because I don't want you to say 3 years after you've seen all these rollouts happening, I didn't even know. No, I'm bringing it to you at the time where they're beginning to roll this stuff out. Okay. Let's go on.
In persistent poverty areas. The second key objective involves adapting to changes in the banking industry, including the expanded role of online and mobile banking. This is the first major revision of the CRA regulations since 1995, before the widespread use of online and mobile banking. The final rule updates the CRA regulations to evaluate lending outside assessment areas based on bank facilities, with additional areas evaluated due to the growth of non-branch delivery systems, such as online and mobile banking, branchless banking, and hybrid models. This means that banks will be evaluated on their mortgage and small business lending, whether it's done from a branch or online. This is a business model neutral approach. The third objective is to provide greater clarity, consistency, and transparency in the CRA evaluation, which stakeholders across the spectrum have asked for.
Okay, let's not move too fast through that one, right? And so, as you can see, with the bank size, business models, and local conditions, right? Mobile banking and online banking, those that don't even have a physical location. So I know some of you guys utilize mobile and online banking. Do you know if they understand what is happening with the Community Reinvestment Act? Because a lot of times we assume that banks have updated their policies and practices, but that's not true, right? We hope they do, because that's how you do good business, to make sure that you're providing your customers with everything that they have access to. But we cannot assume these things. Do you even know if your mobile or online banking has a legal department that you can reach out to about these regulations? If not, you should find out, right? Because like I said, who's the stakeholder? It says promote transparency and public engagement, right? They're talking about low income to moderate income communities. What's the threshold for that? Do you know? You have to know these things. Tailor performance standards to account for difference in bank size, models, and local conditions. What are the local conditions they're talking about? Right? So I can spend the time that I am going to spend with you explaining these things, but it's also up to you to go and research more of this information. And then to confirm that the CRA, or the Community Reinvestment Act, and fair lending responsibilities are mutually reinforcing, working together, right? So do you understand your rights under fair lending? What if you're denied a loan and you believe it to be unfair practice, an unfair lending practice? What if you are a victim of an unfair lending practice? Do you know who to complain to? And so these are all things, because a lot of times in our communities, we have been victimized by predatory lending practices, all kinds of stuff. Payday loans and different things like that. And so this has to do more with you than you think. And so what I want you to do is share this information out with your neighbor, with your family, and your local organizations, so that they can understand how to best serve the people that they claim to represent.
One way the final rule accomplishes this is by using metrics as part of the approach to evaluating bank retail lending, community development financing, and employs benchmarks based on market and community data. Another way the rule offers greater clarity and consistency is by more clearly defining community development activities, such as affordable housing. The final rule also tailors the CRA evaluation and data collection requirements to the size and business type of the bank. Similar to the bank size categories under current rules, most banks will be evaluated under the final rule as either small banks, intermediate banks, or large banks. The final rule retains a limited purpose category and the strategic plan option. The final rule tailors the tests and data collection to each of those categories. For instance, there are no new data collection requirements for small or intermediate banks, and the agency sought to leverage existing data as much as possible. The final objective that we will highlight is promoting a consistent regulatory approach that applies to banks regulated by all three agencies. Not only did all three agencies work together to adopt this rule, but they also will work together in its upcoming implementation.
What does that regulatory enforcement mean, right? That has to do with how all of the things that banks are required to implement according to this act are carried out, right? And so when they're saying that these agencies are tasked with regulatory enforcement of the and overseeing the implementation, we need to understand what that means. I'm going to talk a little bit about that, but you have to go back and do your research. I'm going to drop links in the chat that are going to help you to be able to research and study on your own some of these things so you can understand what they mean. But this is more of me making you aware of this rulemaking, rollout, implementation, and all of the things that it entails, right? And so I felt like having their website and the way they explain it be the beginning step for your understanding.
These next few slides move from the basic architecture of the current rule to the final rule's evaluation frameworks. For clarity, we will refer to the current rule in this presentation. We are referring to the regulation in effect prior to the applicability dates of the final rule, which was approved on October 24th of 2023. In the current rule, institutions are evaluated under different CRA examination procedures based on the asset size or business model of the institution. Large bank exam procedures include an analysis under three separate tests: the lending, investments, and services tests. The lending test includes both a retail lending component and a community development component. And the service test includes both retail banking services and community development services. Intermediate small banks are evaluated under the small bank lending and community development tests. Small banks are evaluated under the lending test for small banks with the optional consideration of investments and services. Wholesale and limited purpose banks are evaluated under a community development test for wholesale and limited purpose banks. The chart on this slide summarizes the evaluation approach under the new rule for all bank types, apart from those banks that elect to be evaluated under an approved strategic plan. This tailored evaluation framework also utilizes different performance tests to assess banks of different asset sizes and business models. Compared to the current framework, the final rule retains the three bank asset size categories, but we increase the asset thresholds at which a bank moves from one category to the next. Effective January 1st, 2024, institutions with assets of at least $1.564 billion are considered large banks. This threshold will be increased to $2 billion under the final rule on January 1st, 2026. Under the final rule, 4 performance tests will be applied to large banks: the retail lending test, the retail services and products tests, the community development financing test, and the community development services tests. Each test focuses on activities that advance financial inclusion in low and moderate income communities and to low and moderate income individuals.
Do the low and moderate income communities and individuals understand what these tests mean, what they entail, right? And so this is a lot to process. You have to go take a screenshot, do whatever you need to do, rewind this, whatever you have to do, watch it again, and look up what retail lending test means. What does it mean for a bank to be able to elect? You heard them say under their own election, right? And then the existing CD test and the CD financing test and the services test, right? What does all of that mean? So I'm going to be dropping those links in the chat that you will have access to understanding more about what's being said, because all of this has already started to roll out.
Currently, banks with assets from $391 million to less than $1.564 billion are considered intermediate small banks. We renamed the category intermediate banks and increased the asset size range to $600 million to less than $2 billion in assets. Intermediate banks will be evaluated under the retail lending test and the community development test that is currently applicable to intermediate small banks, unless they opt to be evaluated under the new community development financing test. Currently, the asset size threshold for a small bank is less than $391 million. This threshold is revised to assets of less than $600 million in the final rule. Small banks will continue to be evaluated under the existing small bank performance standards, unless the bank opts into the new retail lending test. In addition, small banks may elect to have their retail services or community development activities evaluated to enhance their performance evaluation and rating, but these activities are not required. The final rule also retains the limited purpose designation. However, this designation now consolidates the former wholesale and limited purpose designations. Limited purpose banks will be evaluated under the community development financing test for limited purpose banks. As with the existing CRA rule, banks will still be able to submit a strategic plan to their regulator for review and approval. However, the final rule makes some changes to the strategic plan requirements.
Assessment areas are the primary areas in which banks are assessed on their CRA performance. Under the existing regulation, banks are evaluated in assessment areas identified by where they have a main office, branches, and deposit-taking ATMs. Our goal with the final rule was to take a both-and approach to evaluating banks, both where they have branches as well as where they are lending or engaged in other relevant activities outside of their branch networks. This approach takes into account changes in the banking landscape over time with the rise of mobile and online banking and ensures a comprehensive evaluation of a bank's activities. The final rule retains the requirement to delineate assessment areas around main offices and branches, as well as deposit-taking remote service facilities, which includes ATMs. These are called facility-based assessment areas. Large banks and limited-purpose banks are required to delineate facility-based assessment areas consisting of one or more contiguous counties within an MSA, or one or more contiguous counties within the non-metropolitan area of a state. For intermediate banks and small banks, however, the rule provides these banks with greater flexibility and allows them to delineate partial county facility-based assessment areas. This is consistent with current practice and recognizes their smaller service areas. Also, like today, facility-based assessment area delineation must not reflect discrimination and must not arbitrarily exclude low or moderate income tracts. For facility-based assessment areas, all applicable performance tests will be applied when conducting the bank's CRA evaluation. For example, large banks will be evaluated on all 4 tests in each facility-based assessment area. Outside of their facility-based assessment areas, the final rule requires large banks to delineate retail lending assessment areas where a bank has concentrations of closed-end home mortgage and or small business lending. Under the final rule, a large bank must delineate a retail lending assessment area in each geographic area where it originated at least 150 closed-end home mortgage loans or at least 400 small business loans that are reported in each year of the prior 2 calendar years. These geographic areas include MSAs or non-metropolitan areas of a state, excluding counties that are part of the bank's facility-based assessment areas. For retail lending assessment areas in non-metropolitan areas of a state, counties are excluded if the bank did not originate any closed-end home mortgage loans or small business loans that are reported loans during that calendar year. Recognizing that some banks continue to do most of their lending where they have a branch presence, the final rule includes an exemption from the retail lending assessment area requirement for large banks that conduct more than 80% of their retail lending in facility-based assessment areas. Intermediate and small banks are not required to delineate retail lending assessment areas. It's important to note that for any large bank with a delineated retail lending assessment area for an evaluation year, only the loan products that trigger the delineation are evaluated that year. This would include closed-end home mortgage loans or small business loans or both. No other type of retail loans are evaluated in a retail lending assessment area under the retail lending test, and no other performance tests apply. Second, in the final rule, the agencies evaluate a bank's retail lending conducted outside the bank's facility-based assessment areas and retail lending assessment areas. This area is described as the outside retail lending area, or ORLA, as we sometimes refer to it. As we will discuss in a moment, lending evaluated in the outside retail lending area must meet a 15% major product line standard. That is, the bank's loans in a particular product line comprise 15% or more of all of the bank's loans across all product lines in the facility-based assessment area or outside retail lending area. For intermediate banks and small banks that opt into the retail lending test, lending in their ORLA is evaluated when more than 50% of their retail lending is outside of facility-based assessment areas. For intermediate banks and small banks opting into the retail lending test that do not meet this threshold, these banks also have the option to have their retail lending evaluated in their outside retail lending area. Also noted on this slide, the final rule clarifies the areas where a bank is evaluated on their community development performance. The agencies will consider all community development qualifying activities regardless of location. This will provide greater certainty and recognize many community development lending, investment, and service opportunities in rural and other underserved areas. Community development loans, investments, and services conducted outside of facility-based assessment areas are considered at the state, multi-state MSA, and at the institution levels as applicable. The final rule responds to stakeholder feedback about improving transparency and certainty about the community development activities that are eligible for CRA credit. One key part of the rule is the establishment of standards that clarify when banks will receive full or partial credit for a community development loan, investment, or service. The standards include 1. A majority standard, which generally considers whether a majority of dollars, beneficiaries, or housing units go to one of the enumerated community development categories, or 2. In cases where the majority standard is not met because, for example, such data is not readily available, banks could still get full credit for activities that have the express bona fide intent of community development. 3. Banks will also get full credit for activities associated with low-income housing tax credit, affordable housing programs, or those activities that are conducted in conjunction with minority depository institutions, women's depository institutions, low-income credit unions, and Treasury Department certified community development financial institutions, or CDFIs. 4. Finally, similar to the current rule, partial or pro rata credit is provided for mixed income rental housing that provides affordable units in conjunction with a government program. For additional clarity, the agencies will maintain and periodically update a publicly available illustrative list of qualified community development activities. In addition, the agencies will develop a process for banks to confirm the eligibility of community development activities in advance. As you're aware, the definition of community development under the current rule contains 4 categories. Under the new rule, the agencies have expanded the current definition of community development to include 11 categories. The new categories generally build upon the current definition of community development and incorporate certain existing guidance into the regulation in order to provide more clarity and certainty regarding the types of activities that will be considered community development. Here, we will highlight a few provisions included in these categories. First, the final rule retains a category for affordable housing activities. Specifically, the categories include 5 different components of affordable housing. The first component is rental housing in conjunction with a government affordable housing plan, program initiative, tax credit, or subsidy. Qualification under this component of the final rule includes, for example, activities with rental properties receiving low-income housing tax credits or subsidized by government programs that provide affordable rental housing for low or moderate income individuals, such as project-based Section 8 rental assistance and the Home Investment Partnerships Program. Second, affordable housing includes multifamily rental housing with affordable rents or naturally occurring affordable housing. The final rule provides clear standards for when this type of multifamily rental housing that does not involve a government program will be considered. The affordable housing category also includes 1 to 4 family rental housing with affordable rents in non-metropolitan areas and activities that support affordable owner-occupied housing for low or moderate income individuals. Finally, mortgage-backed securities are included under this category if a majority of the underlying loans finance affordable housing for low and moderate income individuals and meet certain standards. The new rule also updates the economic development category to include 3 distinct components. First, economic development includes loans, investments, and services undertaken in conjunction or syndication with government programs with 2 distinct subcomponents. Under this subcomponent, activities may support small businesses or small farms as defined by the applicable government program, plan, or initiative, or that support small businesses and small farms.
Are you an owner of a small business? Do you own a small farm? Excuse me. Like I said, this has more to do with you than you think, right? You have to be able to understand what is happening in this rulemaking, what activities qualify, who's going to be implementing it, what is the new rules for big banks, small banks, and the other banking category, I can't remember what it said right now, limited purpose use banks, right? What does that mean? And who's going to regulate it? Because the three agencies are tasked with implementation and regulation, right? And so when we finish watching this, I'm going to show you where to go. And if you're a consumer that has a complaint, right? Because a lot of times these activities are supposed to take place in ways that allow for, in its intent and practice, the equitable allocation of resources, programs, whatever the bank is doing, right? These activities and all the stuff that's going to be explained here. However, we know that that doesn't always happen, right? So then what do you do as a consumer to notify the regulatory agencies that what they said was going to be implemented was not implemented in your scenario, in your city, in your community, in your neighborhood, or that there was some discrimination that took place, right? Because when we don't go on record, like the 950 comments that were given during the time of this rulemaking, then other people dominate these spaces, and we find out 3 to 5 years later when there's nothing left, or when we're staggering to say, hey, how do we figure out how to tap in, right? And so that's why I'm bringing this information to you, so that you can understand and be well informed about what's going on, so you don't have to watch other people access stuff around you and not knowing what is happening. Because like I said in the beginning, did the local organizations know about this? Did they inform you about this? Have the banking classes that you take on financial literacy talk to you about this? Were you talked to by the community branches of the Federal Reserve all across this nation? Did they tell you that upcoming was going to be a rulemaking period, and we want to hear about these activities from you, your experiences with them, banks, right? And so here we are getting the information at the beginning of its implementation and rollout. The rules have already been set as of October 2023. These are going to roll out over years. And so I want you to understand now what is happening.
Which are defined in the final rule as businesses with gross annual revenue of $5 million or less. Activities with small business investment companies, certified community development entities, and rural business investment companies would be presumed to qualify under this component. The second subcomponent includes certain direct loans to small businesses and small farms in conjunction or in syndication with government programs that meet a size and purpose tests that are similar to the current regulation. To meet the size eligibility standard, the loans must be to businesses and farms that meet the size eligibility standards of the Small Business Development Center or the Small Business Investment Company programs, or that meet the definition of small business or small farm noted previously. To meet the purpose test, the loans must have the purpose of promoting permanent job creation or job retention for low or moderate income individuals or in low or moderate income census tracts. For example, SBA 504 loans will qualify under the direct lending component. Economic development also includes loans, investments, and services provided to intermediaries and other forms of assistance to small businesses and small farms. The final rule replaces the current revitalization and stabilization activities component of the community development definition with 6 new place-based categories of community development activities. 4 of the place-based categories focus on low and moderate income areas and distressed or underserved non-metropolitan middle-income census tracts, including activities related to revitalization and stabilization, essential facilities, and essential infrastructure. This category also includes disaster recovery activities in designated disaster areas. The place-based categories include two new categories of activities, including disaster preparedness and weather resiliency, which covers activities to help individuals and communities prepare for, adapt to, and withstand natural disasters or weather-related risks or disasters. The other new category is activities in native land areas. The provisions in this category reflect the unique economic, credit, and financial service needs of Native and tribal communities. All of these categories specify that eligible activities must benefit or serve residents, including low or moderate income individuals, and may not directly result in the forced or involuntary relocation of low or moderate income residents in the targeted census tracts or other specified areas. Lastly, of note, is a category providing community development credits for activities with minority depository institutions, women depository institutions, low-income credit unions, and CDFIs. The agencies established a set of impact and responsiveness factors in the final rule that will inform the qualitative review for the community development financing and community development services tests, as well as the community development test for limited purpose banks. These factors help to identify loans, investments, and services that are especially impactful and responsive to community needs. Some examples include activities that serve persistent poverty counties and other high poverty areas, activities that support small businesses or small farms with gross annual revenue of $250,000 or less, investments in projects financed by low-income housing tax credit and New Markets tax credit programs, and activities that support minority depository institutions, women depository institutions, low-income credit unions, or CDFIs.
The next few slides provide details on the performance tests. As you can see, the product lines evaluated under the retail lending test are limited to 4: closed-end home mortgage loans, small business loans, small farm loans, and automobile loans for a bank in which that loan product represents a majority of the bank's lending, or if a bank opts for it to be considered. Closed-end home mortgage loans, small business loans, and small farm loans must also meet a major product line threshold to be evaluated under the retail lending test. As mentioned earlier, the major product line threshold is 15% or more of the bank's loans across all product lines in the facility-based assessment area or outside retail lending area. We should note a few additional points about small business and small farm loans. Under the current approach, call report data definitions and data requirements are based on the size of the loan and not gross annual revenues of the businesses or farms. More specifically, the lending data is limited to loans in an amount of $1 million or less to businesses and loans of $500,000 or less to farms. And these reported loans are not subject to any limitation on the size of the business or farm. Under the final rule, the agencies are maintaining call report definitions of small business loan and small farm loan until the agencies transition to using Section 1071 data in CRA evaluations. The final rule establishes a set of retail lending metrics and benchmarks to evaluate a bank's retail lending. The first metric is the retail lending volume screen. It measures the dollar volume of a bank's retail lending in its facility-based assessment area relative to its deposits over the years in the evaluation period. This calculation includes originations and purchases of home mortgage loans, multifamily loans, small business loans, small farm loans, and automobile loans for banks in which automobile lending is a product line. The second set of metrics are applied to each of a bank's product lines and evaluates the geographic distribution of loans by evaluating the bank's percentage of loans in low and moderate income census tracts. The metrics will also evaluate the borrower distribution, which is the percentage of loans to low and moderate income borrowers, as well as to small businesses and small farms of different sizes. For small business and small farm lending under the borrower distribution, the agencies are adding an evaluation of the distribution of loans to businesses or farms with gross annual revenues of $250,000 or less, and loans to businesses or farms with gross annual revenues of greater than $250,000, but less than or equal to $1 million. Another general point to note here, the low income and moderate income categories are analyzed separately under the metrics approach. Each of a bank's distribution metrics will be compared to two sets of benchmarks. Market benchmarks, which represent the aggregate performance of other reporting lenders in a geographic area during the time of the bank's evaluation, and community benchmarks, which reflect local demographic information, such as the percentage of low-income families in a facility-based assessment area. Together, these benchmarks are intended to reflect the lending needs and opportunities in an area. For each product line category, a bank's performance is then translated into a conclusion using performance ranges and thresholds that establish the level of performance needed to achieve a particular conclusion. For example, the percentage of mortgage lending to moderate income borrowers that corresponds with a high satisfactory. This is a change from current evaluations, which do not provide formal guidelines on the percentage of lending that generally corresponds with different levels of performance. The local community and market benchmarks form the basis of the performance ranges and performance thresholds, which allows for a tailored approach to each retail lending test area. In summary, the retail lending test provides a bank with greater consistency and transparency about CRA performance expectations. It tailors expectations to the unique conditions in different markets and automatically adjusts performance thresholds over time in a way that reflects changes in business and economic cycles. As a whole, the retail lending test provides greater transparency for banks and the public. In terms of the role that qualitative factors in performance context play, the final rule provides that when evaluating a bank's retail lending, the agencies will consider qualitative factors, such as a bank's business model and information about the community that is not already captured in the metrics. Thus, performance conclusions will not be based on metrics and benchmarks alone. The retail lending test conclusions for each state will be based on the weighted average of the bank's performance in each facility-based assessment area in the state and retail lending assessment area in the state. For institution-level conclusions, the agencies will take the weighted average of the bank's performance in each facility-based assessment area, each retail lending assessment area, and the outside retail lending area. Turning next to the retail services and products test. This test has two prongs: retail banking services and retail banking products.
So I couldn't get my mic unmuted. Sorry about that. Before they go into this next area, I want to talk to you. So I know some of y'all fancy folks might not consider yourselves low to moderate income, and that, hey, that's what it is. Okay, whatever you have as an income, that's your household business, that's fine. I do want you to be aware of how low to moderate income is calculated in your area, right? We have, based on the housing and census tract data that you keep hearing here, you keep hearing about housing development, you keep hearing about census tract data. So where I live, there are communities based on the averages in those counties where people making, and I'm not talking about person with 4 children, I'm talking about an individual making $100,000 to $110,000 a year is considered low income. I want you to hear that, right? So you have to look at the way that is calculated and understand that this may have more to do with you than you think. I've been saying that all along. I know a lot of times when we start saying low income, people want to avoid saying that they're low income. And hey, that's your business. Again, that's your household business. That's fine. But understand that the rulemaking has already rolled out. that the rulemaking is done and the implementation stage is here, right? Whether you consider yourself low to moderate income or not, doesn't matter. This is based on the census tract data and the housing development, the housing and affordability. So housing, typically like housing authorities, like HUD, right? They calculate things a little bit differently. So I know you hear about poverty levels and income levels. You need to see the way that it's calculated according to housing, right? The census tract as well. I want you to go and be diligent about understanding how these final rules apply to you across this nation. You know, I can't say for your state, while we're doing this broad educational discussion, intel drop, what exactly that means for you, right? You need to go and be diligent about researching those levels of income, finding out this information, figuring out how it applies to you. Are you a farmer? Are you a farmer? Or do you have a small farm, a small business, right? Thinking about that. And thinking about what your access to banking and even loans has been before and how that may be dynamically changed. So let's continue.
This test evaluates the availability and responsiveness of a bank's retail banking services and retail banking products targeted to low and moderate income individuals, families, or households, low and moderate income census tracts, small businesses, and small farms. While the evaluation continues to be predominantly qualitative in nature, it also incorporates some quantitative measures as guidelines. Building on current practice, under the retail banking services prong, the agencies evaluate bank delivery systems, starting with the branch availability component. This evaluates the geographic distribution of a bank's branches in each facility-based assessment area compared to the geographic distribution of census tracts, households, businesses, and branches of other banks. The branch availability component continues to consider a bank's record of opening and closing branch offices, the reasonableness of branch hours, and the range of services provided at branches across census tracts of different income levels. The final rule also provides qualitative consideration for branch facilities in areas such as underserved and distressed non-metropolitan middle-income census tracts and native land areas. The second component of the retail banking services prong evaluates the availability and distribution of remote service facilities. The definition of remote service facilities captures ATMs and other deposit-taking facilities, such as interactive or virtual ATMs, where customers can connect with bank staff through a terminal. Like the branch distribution analysis, this evaluation uses benchmarks to complement the qualitative analysis and considers remote service facilities in other geographic areas. The third component of the retail banking services prong evaluates a bank's digital delivery systems and other delivery systems, and is required only for large banks with assets of more than $10 billion and large banks that do not operate branches. These delivery systems include, but are not limited to, mobile and online banking. Banks with assets of $10 billion or less with branches will have an option to be evaluated for digital and other delivery systems for additional consideration. Under the retail banking products prong of the retail services and products test, examiners will qualitatively evaluate a bank's efforts to offer credit products that are responsive to the needs of low and moderate income consumers and communities, small businesses, and small farms. Responsive credit products and programs may include, for example, those that facilitate home mortgage and consumer lending targeted to low or moderate income borrowers, meet the needs of small businesses and small farms, including small businesses and small farms with gross annual revenues of $250,000 or less, are conducted in cooperation with minority depository institutions, women depository institutions, low-income credit unions, and Treasury Department certified CDFIs, are low-cost education loans, or are special purpose credit programs. Also under the retail banking products prong, large banks with assets more than $10 billion will have deposit products responsive to the needs of low and moderate income individuals reviewed. This would include accounts certified by the Cities for Financial Empowerment as meeting the Bank on National Account Standard, and savings accounts targeted toward low or moderate income individuals, families, or households. Importantly, the evaluation of responsive retail banking products may only contribute positively to the retail services and products test conclusion. This review is optional for other banks. When assessing performance under the retail services and products test, branch availability, branch-based services, and the availability of remote services facilities is analyzed at the facility-based assessment area level. The third component of the retail banking services prong, digital delivery systems and other delivery systems, as well as the retail banking products prong, is evaluated at the institution level.
Now we're going to shift our discussion to the community development financing test.
So I hope you're paying attention to these tests, right? The agencies are telling you how they evaluate and assess the banks, right? So like I said, if you need to go back and repeat this, I'm going to be sharing some links at the end of this presentation that they're doing, talking a little bit more about how consumers can file complaints. But the agencies that are tasked with implementation, regulation, and enforcement of these rules are telling you how they evaluate and assess the banks and the activities. So I want you to take notes or do whatever you have to do to be mindful of that. Because I'm sure that whether it's mobile banking, online banking, a large bank, or maybe you have a medium, small bank, limited purpose bank, do you even know what all that means, right? They've been explaining it throughout this process. That you will be able to understand the activity areas and how that applies to you. And if the bank violates, what to do next.
This test uses metrics and benchmarks to standardize the review of community development loans and investments, while also incorporating a qualitative impact and responsiveness review of community development financing activities. The agencies evaluate community development loans and investments in facility-based assessment areas, plus state, multi-state MSAs, and nationwide areas. Banks receive consideration for qualifying activities anywhere in a state or multi-state MSA in which they maintain a facility-based assessment area. In addition, banks receive consideration at the institution level for any qualifying community development activities conducted. The various community development financing metrics are used to evaluate the dollar volume of a bank's community development loans and investments relative to the dollar volume of deposits. The combined evaluation of community development loans and investments will provide banks with the flexibility to focus on community development financing methods most consistent with their expertise and to provide the type of financing that is most needed for a particular community development project. In addition, the agencies will count both new originations, purchases, and increased balances, as well as prior loans and investments remaining on the bank's balance sheet in the numerator of the metric in order to emphasize the provision of patient long-term capital. A community development investment metric and benchmark were included in the community development financing test for banks with more than $10 billion in assets. The metric and benchmark will measure community development investments such as low-income housing tax credit and new markets tax credit program investments, and may contribute positively to a bank's nationwide conclusion. Limited purpose banks are evaluated under the Community Development Financing Test for limited purpose banks. Similar to the large bank Community Development Financing Test, the Community Development Financing Test for limited purpose banks includes community development financing metrics that measures the dollar volume of a bank's community development loans and community development investments together. However, for the Community Development Financing Test for limited purpose banks, community development loans and investments are measured against the bank's assets as opposed to its deposits. In determining the conclusion for the Community Development Financing Test at the facility-based assessment area level, examiners will consider the applicable metrics and benchmarks, the extent to which the bank's activity was impactful and responsive, and the relevant performance context of the facility-based assessment area. In determining the conclusions for the Community Development Financing Test at the state, multi-state MSA, and nationwide level, examiners will consider two components. Under Component 1, examiners consider the weighted average of facility-based assessment area performance using deposits and a combination of retail loan dollars and loan count. And under Component 2, examiners consider the applicable metrics and benchmarks, the extent to which the bank's activity was impactful and responsive, and the relevant performance context for the state, multi-state MSA, or the nationwide level. The Community Development Services Test evaluates the extent to which a large bank operates community development services in its facility-based assessment areas and at the applicable state, multi-state MSA, and nationwide levels. The evaluation is primarily qualitative and is based on any relevant information provided by a bank, including information such as the number of community development services attributable to each type of community development criteria, the capabilities in which the bank representative served, such as a board member of a nonprofit or in a technical assistance role, and the total number of hours for all community development services performed by the bank. The evaluation also considers an impact and responsiveness review of services that are high impact or especially responsive to community needs. In addition, the final rule maintains the existing requirement that community development services must be related to financial services or the expertise of bank staff.
The next several slides focus on ratings. The final rule provides greater transparency and consistency on assigning conclusions and ratings for a bank's overall performance that is grounded in performance in its communities. Under the final rule's methodology, each performance test results in a performance score and conclusion at the state, multi-state MSA, and institution level. These performance scores are combined using a weighted average approach, with the value resulting from this calculation translated into the rating for the respective state, multi-state MSA, or institution. With respect to conclusions, the agencies maintained the current 5 categories of outstanding, high satisfactory, low satisfactory, needs to improve, and substantial noncompliance. For ratings, the agencies assign one of the statutory ratings of outstanding, satisfactory, needs to improve, or substantial noncompliance. For large banks, the agencies determine a bank's state.
So if you're having an issue with banking and you saw discriminatory or illegal practices, right? You saw that on the list for the ratings. How are they going to rate the bank that you use if you don't put in a formal complaint. It doesn't matter if you called the bank manager and said this was not fair, or who you had a conversation with over at customer service. Without a formal complaint, their ratings don't reflect the practices. Oftentimes, I had this as a personal experience recently with a bank, and I had to raise it to the federal level, right? Because they did not update their policies, and I understood the policy very well. They didn't want to get legal on the phone. That's fine. You can talk to the regulating agency then. I'm explaining a policy. I'm notifying them that their policy wasn't updated to reflect what the law said, and that there were amendments to the law that they were obligated to be in compliance with. I couldn't get anybody but customer service on the phone, right? They said the legal department doesn't talk to customers. Not a problem. So the legal department does have to talk to the regulatory agencies. And if you do not codify your complaint with the appropriate regulating agencies tasked with implementing regulating rules and laws and oversight and enforcement, they don't know. And so the ratings don't change, and nobody ever knows it happened except for you and maybe your neighbor hearing you complain about it or calling on the phone if your walls are thin, and your cousin and them might know, right? You have to follow through in the codified way, in a codified system, so that people don't continue to come into our communities and do what they want, however they want to do it, right? So let's continue.
Multi-state MSA, and institution rating by combining the bank's performance scores across all 4 performance tests. The agencies maintain the emphasis on retail lending and community development financing by giving these tests the heaviest weights. The final rule provides a weight of 40% each for the retail lending test and community development financing test performance scores. The retail services and products test and community development services test performance scores account for 10% each. In addition to the weighting of the performance tests, the rule requires that, as applicable, for each state and multi-state MSA, and at the institution level, the retail lending test conclusion for a large or intermediate bank needs to be at least low satisfactory in order for the bank's overall rating to be satisfactory or higher. Also, the agencies impose an additional restriction on state, multi-state MSA, and institution level ratings for the large banks with 10 or more assessment areas in a state, a multi-state MSA, or overall. A large bank with 10 or more assessment areas, including facility-based assessment areas and retail lending assessment areas, will not be eligible to receive a satisfactory or higher rating unless it's achieved an overall performance conclusion of low satisfactory or better in at least 60% of its assessment areas. For the first examination under the new rule, this restriction will only include facility-based assessment areas. That is, it will only apply to banks with 10 or more facility-based assessment areas. Retail lending assessment areas will be considered in subsequent examinations.
So they just told you how they assess the banks, right, under this Community Reinvestment Act, and the ratings. They just told you, the agencies just told you what those assessments and tests are about and include, what activities are included, and now how they're rated, okay? So that's very important to make sure that you understand the information that was just provided to you.
The agencies established this modification to the ratings approach to ensure that large banks receiving a satisfactory rating are meeting the credit needs of their entire community, and not just markets with higher levels of lending and deposits that factor more heavily into the weighted average conclusion roll-ups. In this way, overall ratings reflect performance in a broader set of markets served by the large bank. This performance provides an opportunity to large banks to meet the needs of rural and smaller MSA assessment areas that might otherwise be overlooked as insignificant. For intermediate banks, the agencies weight both the retail lending test and the applicable community development test at 50% each, consistent with current requirements. However, an intermediate bank needs to receive at least a low satisfactory on the retail lending test in order to receive an overall satisfactory at the corresponding state, multi-state MSA, or institution level. The agencies are not applying the current requirement that an intermediate bank must receive a satisfactory rating in the Intermediate Bank Community Development Evaluation. Small banks are evaluated using the status quo small bank lending test, so their rating continues to be based on the lending test performance. Small banks can receive an outstanding rating based solely on retail lending performance. Both small banks and intermediate banks have the option to request and may receive additional consideration for certain activities to potentially adjust a rating of satisfactory to outstanding at the institution level. Small banks can request consideration of retail services, community development investments, and community development services. Intermediate banks can request consideration for activities that would qualify under the retail services and products test. If the intermediate bank opts to be evaluated under the community development financing test, the bank can also request consideration for activities that would qualify under the community development services test. Intermediate banks and small banks can also request consideration for providing low-cost education loans to low-income borrowers, regardless of the bank's overall institution rating.
Do you know what your local bank's community development agenda is, right? What are they investing in? Is it just, like she said, small education loans? What housing? What are they doing, right? You should find that out. What types of investments are they involved in regarding community development? That's your homework assignment. Go find out. Your bank, where you get your direct deposit for work or have to cash checks, or whether it's mobile, online, or whatever, ask them, what are they investing in with regards to community development? What are their priority areas? What are they going to expand if they're a large bank based on the Community Reinvestment Act and its rulemaking that just happened, right? These are things that you should be asking them on Monday. Even if they say, we just started rolling it out. Okay, well, I'm a customer that wants to stay informed. Is there a department that can, add me to the list of information, or is that something that you're going to be providing all of your customers, right? So that you can know what their past investments are and what their upcoming priorities of investment will be changing, because that is what the Community Reinvestment Act seeks to do, right? Expand those opportunities and investments. And so don't wait thinking that someone's going to come tap you on the shoulder. And I say that with all respect, because we're constantly talking about being left, in an inequitable allocation of resources cycle, right? Unending cycle. And so I want you all to be well informed about what is taking place and have the right questions and go ask and find out what you have access to.
Finally, we turn our attention to data collection and reporting, which is covered in the next several slides. The agencies recognize the importance of using existing data sources where possible and of tailoring data requirements based on bank size. Under the final rule, small and intermediate banks do not have any new data requirements for the required performance tests. For banks with assets over $10 billion, the agencies established new collection and reporting requirements for deposits data, which include the volume of deposits in the bank aggregated at the county level based on the location of the depositor. Other banks may choose to collect, maintain, and report deposits data. These reported deposits data will be used in calculations in the retail lending and community development financing tests and as part of the weighting calculation for aggregating performance scores. FDIC summary of deposits data will be used for banks with assets of $10 billion or less that do not elect to voluntarily collect, maintain, and report their deposits data based on depositor location. For some such banks, it will be in their interest to opt to collect and report deposits data, since there will be concentrations of deposits in facility-based assessment areas for banks where SOD data is used, which may not be representative of where the bank focuses its lending. In addition, large banks are required to report the delineation of facility-based assessment areas and retail lending assessment areas if applicable. Limited purpose banks that meet the asset size criteria for large banks are also required to report the delineation of facility-based assessment areas. For retail lending, the final rule mostly relies on similar retail lending data to what is used today. Two notable additions to data requirements are, compared to small business and small farm loans data collected today, large banks will have added indicators to flag loans to businesses and farms with gross annual revenues of $250,000 or less, and with gross annual revenues between $250,000 and $1 million. Large banks for which automobile loans constitute the majority of their retail lending originations, or which opt to have their automobile lending evaluated under the retail lending test, are required to collect and maintain data on their automobile loans, including income level and census tract for each loan. The agencies expect this requirement to impact very few large banks. Regarding mortgage lending, the final rule includes language to close some coverage gaps in the Home Mortgage Disclosure Act, or HMDA, reporting requirements. Large banks that are HMDA reporters are required to collect and maintain the location of each home mortgage loan application, origination, or purchase outside the MSAs in which the bank has a home or branch office, or outside any MSA, as required under the current rule. Large banks that are not HMDA reporters due to the location of their branches, but would otherwise meet the lending activity requirements for HMDA reporting, are required to collect and maintain certain data on closed-end mortgage loans originated or purchased during the evaluation period. These data include a small subset of the data field that would be required under HMDA, but are sufficient to evaluate home mortgage lending for these large banks. Regarding retail services and products, large banks are required to collect and maintain data to support the final rule's branch analysis and remote service facilities analysis in a prescribed format. In addition, large banks with assets over $10 billion, large banks that do not maintain branches, and other large banks that request consideration of their digital and other delivery systems have new data requirements for digital and other delivery systems. This facilitates a review of the largest banks and digital banks' performance regarding whether digital and other delivery systems are reaching low and moderate income individuals and communities. Also, large banks with assets over $10 billion and other large banks that request consideration of their responsive deposit products are required to collect and maintain data on deposit products like low-cost bank accounts that are responsive to the needs of low and moderate income individuals and communities. The final rule requires all large banks and similarly sized limited purpose banks to collect, maintain, and report community development financing data. The community development financing data is necessary to construct community development financing metrics and benchmarks used to consistently evaluate the dollar amount of a bank's community development lending and investments. The agencies also require that large banks collect and maintain community development services data in a prescribed format or a format of their own choosing.
Although the effective date of the final rule is April 1st, 2024, only a few of the requirements are applicable on that date. Most new requirements will become applicable on January 1st, 2026. Specifically, new definitions, the increased size thresholds, the new performance tests, and the data collection and maintenance requirements, as well as appendices A through F, are applicable beginning January 1st, 2026. Banks will have until January 1st, 2027 to comply with data reporting requirements every April 1st, beginning in 2027. For agency-approved strategic plans submitted to and determined by the agency to be completed plans prior to November 1st, 2025, they will remain in effect until the expiration date of the plan. Regarding 1071, the agencies are not including an effective date for these Section 1071 related transition amendments in the final rule. Instead, once the availability of Section 1071 data is clarified, the agencies will take steps to provide appropriate notice in the Federal Register of the effective date of the transition amendments. The agencies expect that the effective date will be on January 1st of the relevant year to align with the final rule's data collection and reporting, benchmark calculations, and performance analysis, which are all based on whole calendar years. Now we would like to discuss the provisions that are planned to go into effect on April 1st, 2024. First, Section 16, Facility-Based Assessment Areas. With few exceptions, the requirements are mostly the same as the assessment area requirements under the current rule. Some notable differences include large banks and limited purpose banks are required to delineate full counties. A small and intermediate bank may continue to adjust the boundaries of its facility-based assessment areas to include only the portion of a county that it reasonably can be expected to serve. A bank may not delineate a facility-based assessment area that extends beyond an MSA boundary, and a bank may not delineate a facility-based assessment area that extends beyond a state boundary, unless the facility-based assessment area is located in a multi-state MSA. Section 31, Effect of CRA Performance and Applications. There are no substantive changes in this section from the current rule. Section 43, Content and Availability of Public File. The major change to this section from the current rule to the new rule is the requirement for banks to maintain on their website all information required for the bank's public file, if the bank maintains a website. This provision applies to banks of all size. In addition, there are now requirements to update certain information in the public file on a quarterly basis, including public comments and branch openings and closings. Section 44, Public Notice by Banks. This is an important clarification. Although this section is applicable on April 1st, 2024, banks will not need to use the revised public notice in Appendix F until January 1st, 2026. Until then, banks may continue to use the existing public notice found in Appendix B of Appendix G. Section 45, Publication of Planned Examination Schedule, and Section 46, Public Engagement, do not impose any requirements on the banks, but instead cover agency requirements. Lastly, we want to highlight future plans in 2024, where the agencies will further discuss the new CRA rule. First, there is the National Interagency Community Reinvestment Conference in March in Portland, Oregon. We encourage you to attend, and registration is currently open. In addition, we anticipate offering webinars and other outreach through 2024 that will consist of a deeper dive into specific areas of the regulation. For example, expect additional webinars soon on topics such as the transition and the April 1st, 2024 provisions, assessment areas, the retail lending test, and data requirements. Other webinars will follow throughout 2024. So please stay tuned, and we thank you for your attention.
All right. And so you have that information, and now you understand what is happening with the Community Reinvestment Act. Okay. I'm going to take you over to the sites. Like I said, I don't want to hold you too much longer. I just wanted to inform you of these changes that are rolling out as we speak. Let's see. Here it is right here, right? Part of this you've already heard throughout. So here we are at the federalreserve.gov. I bet you guys probably only thought they dealt with other things, right? We're not going to get into that right here on this show. This isn't what Intel Drop is for. But anyway, as you can see right here, the Board of Governors of the Federal Reserve System, and their whole website shows you what they do, what's happening over there at the Federal Reserve. Actually, I'm on the wrong tab. Let's see. Now I'm on the right tab. All right. So as you can see, the Community Reinvestment Act, CRA, and the information and resources provided below are not inclusive of any updates outlined in the Community Reinvestment Act final rule issued on October 24, 2023. For information on the final rule and compliance dates, you have to see CRA final rule. So I'm going to drop this in the chat, and I want you to go over, and you can also find this information at the Code of Federal Regulations registry. I always talk to you guys about going over there to CFR to find out what rulemaking is open, what public comment is open that has to do with you, right? That has to do with you. And what can you do to put your comments in, right? It's okay if you want to complain to me sometimes, because I give you 10 minutes to vent, and then I say, what are we going to do about this, right? And it's okay if you want to go on TikTok and use your First Amendment right to, air your petition, peaceful assembly and expression, artistic expression, whatever that may be. Provide, free speech education, whatever it may be, right? Whatever it may be, even on YouTube, right? About how you feel about banking and inequitable access to farmers and all this other stuff. But you have to codify what you're saying. Even if you got to do a speech to text and drop it in the rulemaking comment, because if they don't hear from us, they don't hear from us, right? Everything is not always about, let's pull up to the protest line. Even if you do that, the First Amendment guarantees the peaceable assembly to have your grievances redressed and petition. What does that petition look like? Do you have it in your hand? What agency or entity did you petition to redress and resolve your complaint? How do they know the activities of the banks if you only called the customer service and the manager? Right? You think the bank told them about activities that would drop their ranking, their rates? The rating, I mean, I don't want you to think of rates as in the terms of like financial, right? The rating system is what I mean. We just went through those tests. So you see here, the Community Reinvestment Act was enacted in 1977, and it requires the Federal Reserve and other federal banking regulators to encourage financial institutions to help meet the credit needs of the communities in which they do business. Do you have banks in your community? Well, we know the answer to that, right? Including low and moderate income neighborhoods. Is that your community? So banking regulators, the banking regulators for the Community Reinvestment Act are 3 federal banking agencies or regulators are responsible. I'm a little bit tongue-tied. I've been dealing with some allergies, but it's okay. We're going to roll on through. Are responsible for the CRA, for the Community Reinvestment Act. Banks that have CRA obligations are supervised by one of the 3 regulators. Okay? Each regulator has a dedicated CRA site that provides information about the banks they oversee and those CRA ratings and performance evaluations. The Federal Deposit Insurance Corporation, the Federal Reserve Board, and the Office of the Comptroller of the Currency. And that's where I had to file a complaint. And so let's go over to, well, let me scroll down just a little bit. All right. You can see here the Federal Reserve's role, whether you like them or not. It's just here, codified on the website for you to find out more information, right? For you to find out more information. They have their history, rules, how banks are evaluated, all of the stuff that we just went through. And I said it was going to be more in depth on their website if you were willing to go over and look. Now, I'm going to take you to one of the regulators. One of the regulators right here, as you can see, is the Office of the Comptroller of the Currency. Okay. And you can see clear as day consumer complaints. Let me zoom in just a minute because this looks a little bit small and I want you to see. Okay. Supervision and examination. They even have all the stuff that they do, topics on the side right there, right? The OCC provides assistance to customers of national banks, federal savings associations, and federal branches and agencies of foreign banks to answer their questions to help resolve issues they may encounter. Now, I also noted that in your state, you should have a way to codify your complaint. Look it up, right? It might be called one thing in one state and one thing in another, but it should be accessible to you if you believe that the bank has violated your rights, okay? Or has violated the rules and regulations, okay? So you need to know what they are in order to be able to codify your complaint. Now, you can go helpwithmybank.gov. Provides answers and assistance to customers of national banks. The site includes answers to common questions and describes how to contact the OCC for federal assistance. All right, let's go over to another page really quick because I'm sure you're trying to figure out what is this community development involved anyway, right? Well, guess what? You can find out right here again. We're back at the Federal Reserve site, right? What does it involve? Recent things that are going on, consumer context. You can even find out where all of their branches are located across this nation. I'm talking about the Federal Reserve, community development or community branches, because they have them. If you look on the website, you can find out Federal Reserves, right? Now, another thing is you need to know this Community Reinvestment Act is not something that gets new rules every year. right? This is why it's going to take a while to roll it out. These are not things that are updated every year. So this is the time that the update and the rulemaking happened, October 2023. So now we're going to live under those rules with banking, for whatever period of time. I don't know. Tomorrow's not promised to nobody. So for right now, we occupy. Okay. And as you can see, agencies issue the final rule, Community Reinvestment Act, and then you have the consumer and community context. See the 7th issue. So I'm going to put all of this in the chat so that you can go do some homework and find out how this is going to affect you. As you can see, the supervision and enforcement area, it says consumer compliance, consumer affairs letters, enforcement actions, Federal Financial Institutions Examination Council, minority depository institutions, research and analysis, right? Even work opportunities, right? And so community engagement, as you can see, the Community Advisory Council, who's on that? Is someone from your state on there? Someone that represents you, right? Someone that represents your interests. How do they get appointed or elected to this council? You need to be going to find that out, right? And so here are all the things that you can look at as information, and you can see as well at the bottom that this information is going to be connected on OpenGov, USA.gov, and there's more information about the reserve. Listen, I'm telling you that now you know ahead of time, right? You don't have to wait for all of this stuff to get rolled out in 2026 when it's mandatory for the banks to comply for you to know. You know in advance. You need to go and ask the questions to your bank. What is their community development investment look like? What are their priorities? How is this going to shift their priorities? Who at the bank, is that a new position? Is someone going to be tasked with making sure that this is equitable, right? Those are questions that you have a right. You're a consumer. Unless you have, and this is your personal business, unless you have your money in a safe or in jars underneath, maybe you dug a hole with Paw in them. I don't know. It might be. And I'm not making fun of that, because I remember growing up and my grandpa said, I got my money buried in the backyard. And I said, okay, Grandpa, well, that's what you do. Well, now we deal with mobile, online banking, branches, all of that other stuff. And some of y'all probably got cash in the house. That's fine. That's your business. But if you deal with the banking industry, or if you have a small business, or, live in that census tract with low to moderate income and housing development and all of that stuff, and or are a small farmer, this has to deal with you. So I want you to take your time, go back and look at this again. Go to all the websites that I share with you, and I want you to be well informed. Thank you for watching, and I will be back with more information on Intel Drop. See you again next time. Be well.